My name is Pascal Widmer. I'm a founding partner of Alpana Ventures, an early-stage VC firm based in Geneva. Since 2015, we have invested in 45 startups, mainly in Switzerland and in the USA. I will share with you what investors can bring as smart money to startups besides writing a check. So in order to have a good development, a good cooperation, you need to have a sound basis. And for that, we really recommend that you invest as an investor sufficient time to be informed and to learn about the investment you have made into the startups. So it's a two-direction roads. You need to engage regularly. It could be informal, or you can have a little more formatization. That means some reporting that the startups could exchange with you, and that allows you as an investor to ask questions on the business development. What we have seen, which is working well, if it's proximity still at the beginning, even visit, informal team participation, a coffee, or an informal exchange over lunch, could be a sandwich lunch, is to us a valuable time you're exchanging, knowing together and getting a good understanding of what are the difficulties, what is the situation of the startups. Sometimes it's a little more difficult than the others, depends of individuals. So I will really recommend that you try different things, but perseverance is the key word. You have people, they are a little more introverts, some others are not. So let's continue and put the feet into the door, but on a nice way. It's just the way I want to help you. I'm here to help, but if I don't know about your life, if I don't know about your difficulty, if I don't know about your progress, it's very difficult for you as an investor to do that. Usually, I would say investors, VCs, with the life experience they have, know a little bit how to tackle that in a soft manner. So what we have observed in facilitating is from two sides. One side, I definitely believe that you need to have sufficient data. This is one side, right? The formal. That means the startup should find the right format to exchange a little bit business development information, KPIs, financials with you. That's the business side. From the other side, and you need to decide what's right? What's the right format on that. On the second side is the informal get together, and I think for that, it's working well when you visit the startups. What we do, we try to visit them regularly. We try to participate to some sessions with some team members regularly, just also to develop the personal relationship and the both. Personal relationship with data. On the long run, you naturally develop a relationship. Startups are all about agility, growth, and a lot of times founders see the corporate governance as a potential burden. We as an investor believe that should be transformed into resources, and you as an investor, definitely you can be part of it. The board should be as diverse as possible and based on your competency as investors. Could be finance, could be marketing, could be product development. You could join the board as a resource. You need time. You need to be dedicated to it. It could also be on an advisory board, or it could also be on working session. Depending on the stage of the company, boards could happen, on a monthly basis, right after the closing, to make sure everything is going right. And when the company is a little more mature, you can have a quarterly board. You need also to be prepared of, digesting the information, to be able to be active within these boards. Could have advisory board that maybe just on a quarterly basis could be put at work for specific topics that probably you have less intensity into that. But an important thing is really to make sure you get sufficient data to be informed and to be constructive within these sessions. Usually, seed investments up to Series A, the VC are not compensated, and normally the investors are not compensated neither. When the company is a little bit, because resources are scarce, and you try to defend your investment and support the company. At a certain level, when you need to attract different type of talents and move from a kind of board of milice, with goodwill, to maybe a little more professional board. In order to attract this talent, probably there you need to have a compensation plan in place. Could be cash, could be option. But your motivation as an investor to join a board should definitely not be the compensation. It should be your conviction that you're able to help the company with your network and knowledge. So you as an investor, you have a great expertise based on your professional track record, personal life to bring to the young entrepreneur, which is a lot of time younger than you and less experimented. So as an investor, don't be afraid also to share, to coach, but for that you need to have this open relationship. And for that you come back to the previous point we have discussed about building the trust and building the relationship. So this is about informal coaching that you could have in crisis time, but also in positive times, facing hiring, having discussion when you fire people, also could be also some crisis you have between founders. And I think the experience of the investors could definitely put at work, but again, the trust needs to be in place. So as an investor, if you're not on the board, you could definitely bring your expertise in some specific sessions that the company could organize, on some product development, on some issue they have. But of course, for doing that, you definitely need to have this communication channel open. And, it's absolutely fine as an investor if you feel, okay, but I don't feel I can go on the board, it's not my expertise, I don't have the time. You cannot help in every direction. You cannot help in every topics. You just need to dig into what you like, because of course we help much better if we do what we like. You could also sometimes, by asking questions, and if the startup also is asking questions, you discover maybe pain or difficulty they are facing through. And ad hoc, you can just propose your help on this specific topic. So you as an investor definitely have a very valuable network to bring to the startups, specifically when it comes to business development, where the startup is ready to go to market, to scale, to open doors. They need to have customers, right? And that's very difficult to go knocking on doors. So you as an investor, you can think about what is the network you can activate to give opportunity to the startups. Of course, the company and the startup need to be ready. They need to be ready with the right preparation. That means at least, for instance, a one-pager explaining what is the product, what is the solution, what is the USP. Maybe also they could have prepared a tailor-made use case for the company they are pitching to. That's mandatory. The last point on that definitely comes back to the trust. Because if you don't trust, the company, if you didn't do the homework first, building relationship, coaching, experiencing that, you as an investor would probably be reluctant to open the network. In order to open doors, from our side and expertise, what happens a lot of times is, first of all, come back to building relationship and knowing the company. It will happen after a certain time. That means you need 6-8 months actively engaging with the company to really understand where you can be at best in terms of networking and business development. What we do usually is that we visit the startups, we work with the teams, and we look into our networks. Could be from our investors, our own LPs, in what field? Could be in hotels, could be if you're in software or if you're in procurement. So based on that means we can definitely profile which way, when the company is ready to be pushed and presented to corporate. This is a lot of energy that is taken out of the real business of the startup. The startup should focus on the product, on going on sale and growing, and should not focus too much on fundraising. Unfortunately, this is the life of a startup. You know, you're fundraising every 12, 18 months, depending where we are. But smart money could definitely use your network. And that goes back to benefit number one, building relationships. Again, if an investor is happy with the result you have achieved, if an investor trusts you, he's going to be also very happy to open his network of co-investors and speak positively about you as a potential target. Usually when we start, you could have 1 to 2 VC, we're talking early stage. Sometimes it's one doing the lead investors, and if you need to close a round which is going between $500,000 to 1.5, I'm talking here early, small Series A. That means we are happy to open the network and to go and helping to fill the gap. In additional round, a subsequent round, of course, you know, the idea is to continue to build our position, but it's definitely the target to help the startups. Could be in Switzerland, or if the startup is already ready to go and cross borders, could be with the international network. Yeah, so investors could play an active role, could be again the angels, the VC, the family office, but usually it's the VC or the angels, an active role in coaching the company on how to present. You know, you start with a pitch. What is the storytelling about the company? What do we have achieved up to now that makes the company attractive for next round? Of course, what are we targeting to invest the money? You know, what will be developed for? So the pitch, you know, is usually very well organized of what you need to have there, from the team, the history, to the use of funds. And that definitely an investor could help the startup to be effective on that. The other thing also is the terms and conditions that come with a deal. And on that, smart money, definitely investors could be very helpful, avoiding losing times or looking what are the usual terms. Investors and smart money needs exits. You know, when it's not a bad word, a lot of times I say it's a little bit taboo when you spoke with the entrepreneur, I'm gonna take your baby. First of all, entrepreneur can survive after an exit. A lot of time they can even stay within the company. So just understanding that investors needs exit and they come to you because you're gonna provide them an exit, it should be planned from the beginning. Of course, you cannot do in a business plan before the company starts saying, okay, I'm gonna sell my company to Apple or Google. Doesn't make sense. But you need to decide with your investors, what is the type of exit you're looking for? Could be a trade sale, it could be a management buyout, or I'm targeting to an IPO, which happens. And when you have that, you do retrofitting, you do different steps. What are the steps we need to gear toward this exit? So it's sharing expectation realistically of what you need to do in order to reach that. Yes, so a lot of times I think maybe misunderstanding could happen from that. First of all, startuppers, entrepreneur really needs to be clear. If they are looking after smart money wants an exit. And normally they want an exit, ideally, 5-7 years, a little more maybe sometimes, but if we're talking digital companies, the speed of execution is a little shorter. So you need to make sure there is no casting error. And this is something you do when you onboard investors to see if you align on that. What type of expectation? Are we talking about, a unicorn, which in Switzerland is not so often? More realistically, in Switzerland, you're looking maybe from exit between 100 to 300 millions. So I think these type of things needs to be put on the table like that everyone can really forecast expectations. There is a road to exit. It's a roadmap that you need to plan accordingly. Of course, it's over different years, over different rounds. And of course, the roadmap could change and will change for sure. From your original idea, maybe the company pivots, maybe the company realizes down the road that there is, the market is moving also, and you need to adapt on that. And everyone is ready to adapt on that, right? But as an investor, you need definitely to identify what are the milestones. Basically, step one is fundraising. Every 12, 18 months, you need money again to continue the adventure. So that means you need to agree on what are the milestones. And these milestones, all together with different steps, are bringing you to the company that you need to be in order to exit. And that's going to come naturally, but it's important to exchange. And this is why, coming back to the point number 2, governance, if you have your investors around you as partner into a board, into maybe an advisory board, maybe into workshops, you can exchange idea on that. You can exchange on how the company is evolving, and you naturally will tend towards your exit with them. All the side benefits you get out of smart money is definitely side benefits you need to put at work to be efficient in your company. And this is free of charge. You get some new shareholders, new investors, but that's the money that you put at work. But the network and competencies and skills they are bringing around the table is here to be tapped on. So it's up to you as the founders, it's up to you also as the fellow investors to make these skills and network work together in order to create value for the company and to bring a great exit.